Welcome to AllGen's Market Update. My name is Jason Martin. Today is March 13th, 2020. So I want to address a lot of the fears that are out there with the coronavirus and the volatility in the markets, and kind of study a little bit of history and just explain what we're doing with our clients' accounts and how we're managing the markets as we go through this. We want to talk about our investment philosophy and why it's so important to focus on risk. And secondly, we want to reiterate through this whole time, and we'll show some things about this, is that our portfolios we're positioned defensively prior to this market drop and are still positioned defensively. And I want to show you, again, like I often do, the history of times in the market that had extreme levels of fear and how those ended up to be great opportunities in the long run. So let's hop right in. So our investment philosophy is to manage risk first. And what we mean by that is we put majority of our efforts when we're building a portfolio in studying the risk of this specific investment, of the overall portfolio, and test that over time to see how it does in various markets. And the reason why we do this is because if you just take, for example, you take a $100,000 account, right? So large drops are very difficult to recover from. So we take a $100,000 account, you drop 50%, you're at $50,000. To get back from $50,000 back to $100,000, it takes a 100% gain, all right? To make that analogy more extreme, you take $100,000, you lose 90%, you're at $10,000. To get from $10,000 back to $100,000, that's a 1,000% return. So it's very important that you manage risk well and your portfolio doesn't fall as much when the market falls. Then you don't have to make up as much when the markets come back up. So we're okay sometimes if we miss out a little bit on the upside when the markets are going up, as long as we can try to really navigate well when markets are going down. We're also active money managers, and so our philosophy is one that we're striving to, we're really looking hard at all the different indicators and all the economic indicators, all the, markets, and studying different trends and different charts to see if there are any warning signs in the market at all times. We're also looking at the same time for different opportunities. But when we see warning signs, we try to go defensive when those warning signs arise prior to the market actually dropping, not after the market drops, prior to it. At the same time, when the market is dropping, we're looking for indicators that are showing that historically when these characteristics present themselves is typically a good opportunity. And so that way we can get more opportunistic when we see that happen. So we're striving over time to manage our clients' risk and go defensive when things look like they're going to get difficult, times look like they're going to get difficult, and then we strive to look for opportunities after things are difficult or when things are difficult and they look like they could turn around. And we're constantly making small adjustments here and there in the portfolio to manage through that. It's really important to have a portfolio that is made up of non-correlated assets. What is a non-correlated asset? A non-correlated asset is having a group of different investments. Let's just use 3 examples: stocks, bonds, and gold. Okay, so those 3 investments are non-correlated. Okay, and as stocks go up, sometimes bonds go down, and as stocks go down, sometimes bonds go up. And same thing with gold. Gold is not correlated as much to the stock market or bond market. So that way, when you go through a time like we're going through, maybe stocks are going down, as obviously as they are right now, but bonds have been going up and gold has been going up. So it's good to have those non-correlated assets. And at the same time, what's critical over time is that you rebalance. So obviously 2019 was a very strong year. Stocks did really well. And actually, it was an interesting year because bonds actually did pretty good and gold did pretty good as well. But they didn't do nearly as well as what stocks did. So you go through a time period like that, then at the end of that year, you sell off some of your stocks that did well and you buy the assets that didn't do as well. In that case, it would be bonds and gold. And you do that over time. You do that the same way. You also do that when stocks go down and bonds go up. then you sell some of your bonds that went up, and you buy the stocks that went down. And we're constantly doing that over time. We're doing that through what's called rebalancing, and we're actively doing that as we speak. We spend countless hours doing research, looking for each specific mutual fund that we use, looking for the individual stocks that we own, or the different asset classes in general. Literally thousands of hours a year doing that. When we do that research, we are looking not just what are the overall returns of that investment, but how did it do during the bad bear market of 2000 through 2002, during the financial crisis of 2008. How well did those investments hold up in general? Specifically, each one of those investments we go through and look how they did and how they held up during those bad times. Obviously, we want them to do well during the good times too, but we're much more concerned about how they held up during the bad times. So, and then we take all of our different investment ideas, we put them together inside of a portfolio, and we back test the portfolio as a whole, going back as long as that we have historical numbers for, and see how those portfolios as a whole did during the worst of times. And we try to find portfolios that do well during those bad times, and do pretty good during the good times. So that's our philosophy, and that's how we manage money. Now, this chart is a little bit blurry, and I apologize for that, but it's going back to 1918. In fact, the early 1900s, so it's hard to find a lot of history going back to that time. But the point I'm trying to make here is, if just in life in general, I'm going to use the markets, but in life in general, if you can psychologically get past the worst case scenario in your mind, and you can get there psychologically, then it makes it easier to make more sound decisions. And so I've spoken to epidemiologists, immunologists, virologists. We've studied them as well. We studied a bunch of different reports on it. And the worst case scenario of this coronavirus, of the COVID-19, is that we have a repeat of the Spanish flu, which is also the 1918 pandemic influenza. And so, remember, as I'm walking you through this, that 1918, there was no ICUs, there wasn't antibiotics, the hospital conditions were nowhere near what they're at today. Just the medical world in general is not as advanced. So remember that as I'm going through this. But there was over 50 million deaths worldwide from the Spanish flu. I'm not saying that's what's going to happen with the coronavirus. What I'm saying is that all the experts we've heard from say that's the worst case scenario. And so let's look and see what the markets did during that time. So we're looking at the Dow Jones Industrial Average. This chart goes all the way from 1900 all the way to 1926. These two orange vertical lines, this area right here, was 1918 through 1919. And during this time is when the Spanish flu that was the worst part of the Spanish flu. And the market, while there was a little bit volatile, it actually went up during that time. And I do have to disclose, it was a different time frame back then. We were coming out of World War I. But my point is, and we didn't have social media, we didn't have the level of quick access to information. Even if the information was delayed and the market finally realized that how bad it would hurt the economy, and that took a year or two to spread. And if we look at the drop here, which was about a 45% drop, now this was after the flu virus passed. My point of bringing that up is, markets continued to move on once that passed, okay? And this will eventually pass. It's not a matter of if, it will eventually pass. So you can see, and I'm not even going through even further into the 20s where the market kept going up, but the market got through this. So it's important that we look at that to say this was the Spanish flu, which had 50 million deaths. As of right now, the COVID-19 is responsible for about 5,000 deaths worldwide, and I'm not saying it can't get worse, it certainly can, but that's not near 50 million deaths. And the market survived. We got through that. So important to keep that in mind. That was the worst case scenario, that all the comparisons that we're hearing about right now. So this is a chart I reference quite often. I'm not meant to be condescending by the words I'm using. They're not my words, but there is a company called Sentiment Trader that puts out some really good charts. And I show this a lot. It's called the Smart Money, Dumb Money Confidence. And the dumb money that they're referring to would be your average investor that does not have much access to information, that is more trading and investing off a whim. My brother-in-law told me this, I heard this at the bar, you know, and they're investing without doing a lot of research. The smart money would be the ones who are the institutional investors, the pension fund money managers, the people that are more in the know. And the theory goes, and I'll show you it in a second, is that when dumb money gets overly optimistic, that's a bad time to invest. When they get overly pessimistic, it's a good time to invest. And vice versa with the smart money. When the smart money is pessimistic, not a good time to invest. When the smart money is opportunistic, good time to invest. So the red line here is measuring the dumb money. And the blue line here is measuring the smart money. And it's crazy because we put out a report in early February pointing out that the dumb money was at its all-time high of optimism. Literally a month later, we're now at an all-time low in pessimism, how things can change quickly. So, but if you think about it, at all-time high optimism, the market fell. Now we're at an all-time low in pessimism. So historically, when dumb money has been this, well, it's never been this pessimistic, but when it gets an extreme level of pessimism, have been market bottoms. You can see, and it would be too busy if I went back 20 years, but just going back over the last couple years, you can see in early 2019 or late 2018, we had another extreme of low optimism for the dumb money, and that was a great buying opportunity. That was the market ended up going up over 30% after that. Then in February of 2018, we had another extreme level of pessimism. The market ended up rallying from that. So, and I could show you that going back 20 years, the same pattern repeats itself. And so we're at that opportunity right now where there's an extreme level of pessimism. So let me show you one other thing that measures fear. So this is the volatility index. The bottom chart is the volatility index. The top part is the S&P 500. And the volatility index is also known as the fear index. When it gets above 40, okay, and 40 is at this level right here, we've reached an extreme level of fear. And so you can, and actually, unfortunately, this chart doesn't show the VIX going back to all the way to 1980, but in 1987 at the October crash, that was the all-time high in fear. And you can see that happened right around here. Markets ended up recovering afterwards. Same thing in the recession of 91, markets hit a high level of fear. In 1998, they hit them. The second highest level of fear of all time was the credit crisis of 2008. Since the VIX has been in existence, that was the second level, the highest level of fear. And you can see what happened. The market recovered. In fact, it went up from its March 2009 low. It went up over 400%. Still went up over 300% from the time that the VIX hit a very high level of fear. And so right now we're at the third highest level of all time of fear since the VIX has been in existence. And historically speaking, when you have high fear, when you have very high pessimism by the market, is usually a good time to buy. And so within our portfolios, we use these opportunities to do what I was explaining a couple slides ago, to rebalance and to sell some of the bonds that went up and buy stocks that are down. And we do that in small increments because the timing of these things are never perfect. We're never going to know the bottom of the market, but we want to do a couple percentage points at a time to take advantage when markets drop like this and when fear gets really high. So I mentioned this in the beginning, but we are defensively positioned. So if you look right now, this is year to date, January 1st through March 12th, yesterday, which was the bottom of the market so far. The S&P 500 was down 23% year to date. The aggregate bond index, which would be your core bonds, are up about 2%. Long-term U.S. Treasury bonds during that time are up 16%. Gold is up 3.5%, and cash is obviously flat. So you have the market down a lot, stocks down a lot. We understand that and we see that, but you have bonds that are up. in U.S. government bonds, especially long-term U.S. government bonds, we had a decent-sized position in that in all of our portfolios. They were up 16% since the beginning of the year. And gold is up 3.5%. We also have a position in gold. So, you know, like I said, when markets take a big hit and you have bonds that go up and stocks that go down, now we're selling piece of this of bonds in general and these long-term treasuries that have gone up a lot to buy some of the stocks that have gone down. And we're doing that in small increments, but we were defensively positioned going into this. We're still defensively positioned, but we're trying to take small steps to buy stocks as they're going down. Okay, so this looks a little bit busy here, but this looks at each of our benchmarks, and our benchmarks are made up of the S&P 500, which is large U.S. stocks, the S&P 600, which is small U.S. stocks, the MSCI World Index USA, which is international and emerging market, and they're also made up of the Barclays Aggregate Bond, which is your core bond benchmark. And it goes from aggressive all the way down to conservative. Aggressive having 100% stocks, no bonds. Conservative having 20% stocks and 80% bonds. And then moderately aggressive, moderate, and moderate conservative are in between. So benchmark returns year to date, the aggressive benchmarks, not our clients' portfolios, but the aggressive benchmark was down 26%, moderately aggressive is down 20, moderate down 15, moderately conservative down 9, and conservative is only down 3% on the year. I point this out, and for compliance reasons, I can't talk about our client's specific portfolio and what the returns are of their specific portfolio, but I want to encourage everyone. We as a firm, we give our clients a client portal, which is through Morningstar, a large company that helps us show our clients and reports their returns. We want to encourage everyone to not be so discouraged of what we're hearing in the news and how much the markets are down, but actually open up your client portal and look at your specific portfolio and your assets and see what they're down year to date and see how you're holding up during these times. I think you will be pleased, without going into specific numbers, but I think you'll be very pleased to see that our defensive positioning has really helped during this time. So lastly, just to summarize, to reiterate, we're big-time believers in managing risk, and because of that, when we see red flags, and ironically, the red flags that we saw last year and going into this year had nothing to do with the coronavirus. It was just the fact that stocks were overvalued. So, you know, we look at indicators to position defensively, and we were positioned defensively going into this year. Historically, when fear is high, they've been great opportunities to invest. And I just want to take a moment to point out it's very, very important that everyone has a financial plan, okay? You hear the cliche, stay the course. And if you have a good course, that is good advice, to stay the course. Some people don't have a course. And if you're on the wrong course, it's probably not a good idea to stay on the course. But if you have a financial plan, and we're big time believers in paying off consumer debt, having emergency reserves, and doing that first before you even think about investing. And if you're in that position where you have a lot of emergency reserves, you've paid off your consumer debt, when you go through difficult times in the market, they're a lot easier to get through. And as you advance in our path to financial freedom, we talk about paying off your house. And if you can imagine a day when you have no mortgage payment, no consumer debt, no car payments, no credit card payments, no student loan payments, you have 6 months plus of emergency reserves sitting in the bank, and you go through a period like this, you're so much more at peace during those times. I mean, Warren Buffett, you know, one of the most successful investors of all time, holds a lot of emergency reserves. and he gets really excited when markets go down a lot, because when you have a lot of cash sitting on the sideline, you can take advantage of these times. Now, you know, obviously, each one of your cases is not similar to Warren Buffett. He's one of the richest guys in the world. But the theory and the way that he does it, it can work for everyone. So our plan is to pay off all your consumer debt, have a lot of emergency reserves, And then it's easier when you see this volatility in the market to stick with it. If you don't need the money, why would you sell when things are down? You can let it work its way through, because over time markets recover. So I hope this helps. Obviously, if you ever have any questions, feel free to reach out. We're here for you guys, and hope you have a great day.